Hello and welcome to the first tax update of 2026. This was supposed to air last week, but unfortunately I was taken ill and had an unplanned 3-day break on our local acute medical unit. I do apologise for any inconvenience and hope to get things back to our established schedule. In this episode, we're looking at key announcements such as the government climbdown on business and agricultural property relief, an update on HMRC's support for the tax return filing bottleneck, and a case where unpaid rent wasn't permitted to be excluded from the profit calculation. So let's get cracking. And first up, a bit of a Christmas present for my beleaguered farming friends. The government announced that it had, in quote marks, listened to the farming community and had decided to increase the combined cap on 100% BPR and APR from £1 million to £2.5 million. This will be effective when the changes kick in from April this year. This is in addition to the concessions announced at the budget that the cap would be transferable if unused. The upshot is that a couple will be able to enjoy full relief on assets worth up to £5 million. This is a significant improvement on the initial plans, and credit should go to all the representative bodies including the NFU, and to Environment Secretary Emma Reynolds for securing this last-minute reprieve. Next up, there is a limited window to have your say on business rates reform. The government is inviting responses on a number of areas of the planned reform, including reliefs for small business, until the 18th of February. This may be of particular interest to those in the hospitality sector, as demonstrated by recent media coverage. If you want to contribute, follow the link shown here. To Scotland, and the devolved government has announced an above-inflation increase in the thresholds for the basic and intermediate income tax rates. The proposed rates for the next year are shown in the table here. The budget also announced a number of welcome changes to non-domestic rates. As you all know, it's tax return mayhem, aka filing deadline, month. Don't forget that returns and any payments due must reach HMRC by midnight on the 31st of January. This year, that falls on a Saturday, and the department is issuing a reminder that its phone lines, including the agent-dedicated line, will close at 6 p.m. on the 30th. You will not be able to contact HMRC for help on the 31st, so the best approach will be to get any outstanding returns in well ahead of the month end to allow any problems to be resolved. In its latest edition of Agent Update, there is also a helpful top tips section for making claims for overpayment relief. As a reminder, this is the relief that is claimed when the window for amending a tax return has closed and offers recourse where errors have been made. A claim has to include a lot of information in a prescribed format, and there are a significant number of rejections due to procedural errors. HMRC says the two most common are a failure to indicate whether a previous appeal has been made and the declaration not being signed by the right person. If you are assisting a client with a claim, it is essential that they sign it. You can't do it on their behalf, even if you hold a valid authorization. In this first case, the company was a promoter of tax avoidance schemes aimed at workers due to start work as a contractor or via a recruitment agency. We won't go into the details of the arrangements, but they were of a nature that would have required them to be notified under the DOTAS rules. The company operated from 2016 and entered voluntary liquidation in 2020, before finally making a disclosure in 2021. HMRC applied a penalty for failure to notify, calculated under the statutory provisions, but asked the tribunal to impose the maximum possible fine of £1 million. The tribunal assented. It's unlikely that the fine will actually be paid due to the liquidation, and the case probably serves as a deterrent to other promoters who might be considering ignoring their obligations. And finally, taxed on rent that you never received. It might sound harsh, but a closer look reveals a systemic failure on the part of the appellant. Mr. Khan owned a property in London that was let to his limited liability partnership. The rent was invoiced, but not always paid. Mr. Khan omitted the unpaid rent from his tax returns. On the face of things, that seems reasonable. However, as the turnover was in excess of £150,000, the cash basis couldn't be used. The accounts had to be prepared in accordance with UK GAAP. There is therefore no distinction between rent invoiced and rent unpaid, and the taxpayer should have included a bad debt claim. Unfortunately, many of the returns were out of time and the tribunal dismissed the appeal. Okay, that's it for another tax update. It's good to be back and kicking off the new year. Again, I apologise for any inconvenience the delay might have caused. Until next time, from me, Andy Rainford, it's goodbye for now.
Thanks, Andy, and I'm glad you're home and on the mend. Remember to visit our web shop for all our tax solutions in one convenient place. This includes our special report on the 2025 autumn budget. It cuts through the noise and gets to the nub of what the announcements mean in practice, as well as covering all the small print that you might have missed in the mainstream coverage. Take a look at the website shown here.